Welcome to BIV Today, the podcast from the newsroom of business in Vancouver. I'm Kirk LaPointe, publisher and executive editor. The Bank of Canada nudged the central rate up 25 basis points again today to 4.75. It's the highest it's been in more than 2 decades, indicative of lingering inflation, a hot economy that still needs to be tamed somewhat. My guest today is Derek Burleton. He's the deputy chief economist at TD Bank. We're going to discuss what this might mean, how it might affect housing prices, for instance, or consumer spending, and what we can expect for the British Columbian economy. He joins me. Good to have you with us.
Thank you. Great to be here.
Listen, were you in the camp that was surprised about the bank?
Yeah, I think modestly. Market pricing, I think they built in about a 1/3 chance of a rate hike. So, I was leaning towards no change. I thought they might wait for one more month's employment data. We got inflation data out shortly for the month of May. I thought they were going to wait it out, and July was a better chance. But clearly, and just looking at the statement today, it was hawkish. In other words, it wasn't an even-handed kind of typical central bank where they say these areas are strong, these areas we're concerned about tending to fall. It was pretty much, as you pointed out, it speaks to the strength of the data in recent months. So I guess they felt, why wait 6 weeks? Let's pull the trigger now. And now we cast our eyes ahead to the July and kind of wonder the same thing, whether the data will soften up enough between now and then to kind of stay the bank's hand and go back in a pause. And our sense is they probably will go another 25 basis points in July because the data is unlikely to soften enough by then.
So what are the metrics they're really looking for here, Derek? Is it really a 2% inflation? Is that possible to get right now?
It is. The trends point to it was as high as 8% midway through 2022. We're about halfway down the mountain. I think the latest trends suggest we're in the kind of the 3.5% to 4% zone. They reiterated today in their short statement that that's still not good enough. While it's close, no cigar. They want to see 2%. So that's what they're striving for. And I think they can achieve it. It's just going to take a little while longer. And clearly at a higher interest rate setting than most of us had initially thought.
Meanwhile, obviously things like variable rate mortgages are going to go up again, maybe again later, as you point out. What is this really starting to have in the way of a drawn-out impact on things like consumer confidence?
Well, consumers, just based on the surveys we've been looking at, they're somewhat concerned, albeit we've seen consumer confidence readings at lower levels. I tend to pay more attention to what they're doing. And clearly, based on the first quarter data, they're still spending. They're spending on a whole raft of goods and services. Housing has picked up, so certainly more spending on houses than the central bank had anticipated. And I think, again, this points to these long lags. I still think interest rates are going to cool consumer spending. It's just taking a lot longer than we had anticipated. Clearly, until the job market softens, Kirk, there are limits to how much consumers are going to cut back spending, even with the higher pressures from interest rates accumulating in the past year. Mortgage renewals, there's more pressure as more households renew at higher rates compared to, say, 5 years ago. You mentioned variable rates. Those households have been facing steady pressures over the past year. And yet, as long as you've got a job, you have to reallocate some spending, maybe away from some travel you want to do, but you can keep going. And I think that's what we're seeing, certainly based on the data we've seen of late.
So it took longer than I think everyone now realizes was correct for the central banks to recognize inflation. Is it going to take longer for us to cool it down?
Yes, I think that's clearly the message. The stickiness of particularly service inflation is a problem. And, we know it's not going to be in a straight line. I think every data point we're going to scour through to see, okay, are we starting to see that continuation of the downward trend? Because of late, we've seen the progress flatten out. But clearly, it's the job market. That's really the key piece here, because as long as unemployment is as low as it is, as long as wage growth is running at 5%, which is probably a good point to point and a half higher than it needs to be to kind of get that inflation rate steadily down to 2%. It's going to be a challenge. And I think every month we get the Friday data on employment, we'll see if there's any slippage in labor market conditions. We just keep bumping it out. Certainly recession calls keep getting bumped out. We don't have a formal recession call in our forecast,
Right.
But that's we're in. I think we know that we're likely going to get there, maybe at a higher interest rate than we had expected. But at some point, I do see the balance of risk shifting from this year to 2024. That may be more of a period where we see consumer spending start to slow steadily and unemployment to start rising. So that, I think, is where the balance of risks are shifting.
Can we actually have a recession now with this kind of very low unemployment?
Yeah, I mean, the U.S. is an interesting case because Canada's growth is 3% in the first quarter. Early reading of the second quarter this year is that growth is probably going to be, 1 to 1.5. That's not negative. It's not even zero. And our view has been for quite some time, we're in for a kind of a period of zeros, not necessarily contractions, but it's going to take a good 4 to 5, even 6 quarters of kind of stagnation to bring inflation down on a more sustained basis. The U.S., though, it's interesting because their growth, it has been slowing. Canada's been outperforming, and yet it's raising the prospect that maybe we can have a full recession at a time where we've got full unemployment. I mean, it's a strange time, Kirk, just given some of the legacy of the pandemic, excess savings. It's an unusual cycle we're in. So I wouldn't rule it out. We could get a couple quarters of contraction at a time where jobs are still tight. My best bet is that it's just a matter of time. We're seeing some cracks forming in both job markets, Canada, the U.S. It's just taking longer. And I do think in the next few months, we'll see more evidence, more announcements of some layoffs and declining vacancy rates in the job market.
Back to the metrics again, Derek, what do you think will eventually be where interest rates land? Is it, nobody seems to think there'll be this near free money ever again. But how far from free do you think it'll be eventually?
Yeah, I mean, one of the things we did see, and it'll be interesting because with this rate hike today, we did see bond yields, and that is a good proxy for where lending rates are happening. We did see the market was surprised. We saw a big jump in 2-year bond yields right up to kind of 10-year bond yields. I think what that suggests is that, especially with another rate hike possible, you are going to get yields rising. I think where our best view, though, is we do think rates will hit a peak, whether I think this is fine tuning right now. This is probing, and I don't see more than 50 basis points. I guess the big question is, when does the Bank of Canada turn the page and start to cut rates? And our best guess is the markets are in line. It's going to be the first quarter of 2024. At that point, we should be close, maybe a little bit above 2%. But I think the central bank can look ahead and say, we are confident that we are now back on track to achieve our objective. And it's at that point they'll argue that it takes a while for lags of policy. We've got to cut now to get us there. So, but what we're doing at the same time, that end point where we'll see rates fall back to is being raised. And we thought it was going to be around 2.5 by the end of next year. We're now looking with a 3 handle. And I think that we're not alone. I think other banks are looking at something. Some of the data we're getting does suggest that landing spot is going to be higher than we thought. And certainly to your point, it's not going to be zero. I think if we get back to zero, it's going to be because things have really come undone. And that would not be a good outcome for anybody. So the 2.5 to 3 gives you a sense for where we made to be. And I think the balance of risk suggests that maybe it's going to be closer to 3 than 2.5.
Because that sounds as if we're going to get to 5 at a central rate, which means mortgage rates and lending rates will be, probably a couple of points higher than that. That'll sustain for what, maybe 6 months, somewhere in there, 6-7 months, and then you'll start to see a bit of a climb down, perhaps. But it's not going to be a fast descent, is it? It's going to be a quarter point, a quarter point at a time kind of thing, won't it?
My guess is that we're right in our call that unemployment rises, but doesn't shoot higher. It kind of grinds higher as the labor market cools over time. The resilience is still there. We've got strong population growth in Canada, which provides a bit of a demand impulse and an offset. And that's not going to change dramatically. So, I think in that environment where growth isn't contracting, unemployment's, rising gradually, they'll be very careful to cut rates. They'll do it, very, very steady but slow. And, if it's quicker, again, that points to more problems in the economy. What they don't want is they don't want inflation, because you can have head fakes. You can have inflation making progress and then backing up. And they don't want to be caught in that where they've then got to hike rates again. So we saw it often, it's talked about in the 1970s. We had another big upsurge in inflation once the inflation fell. Central banks will not want to see that happen. So I think, to your point, I think it's going to be a very slow climb down, but still declines. We'll see mortgage rates fall back, and that'll provide a bit of breather to households to be renewing through 2024 into 2025.
Yeah. I mean, the pandemic's not over. I've got a couple of friends that are still battling COVID and all that. But I think for, all intents and purposes, we no longer have that focus on the pandemic effects on our economy. Are you able to gauge yet about whether there are any permanent issues that the pandemic has left behind here?
Yeah, it's still early-ish days, but I mean, it doesn't certainly stop discussion about some of the ongoing legacy effects of the pandemic. I think within the labor market, we've certainly seen the hybrid work model evolve, and it does look like we're landing on somewhere in the middle. I think there was a little bit of doubt as to how long we would sit at kind of 2 to 3 days a week in the office. Seems like we're steadily there. Now, longer term, one can, again, speculate whether we'll see a little bit of a gradual uptick from kind of 2 to 3 days, maybe to 4 days. There's all sorts of discussion about impacts on productivity from the pandemic. We're seeing it not just in Canada, but in the United States and Europe. Productivity is quite soft. And whether the work-life balance certainly has shifted. I think, anecdotally, we know that a lot of households, and some of them, and still enjoying a bit of a war chest of savings that were built up during the pandemic, certainly shows up in the aggregate numbers. But it's kind of shifting a bit of the work behavior at a time where, the aging baby boomers are leaving the labor force. So I think with workplace, certainly some lingering impacts on office real estate. We'll be talking about those for quite some time. I guess that's really where the meat of the discussion right now in terms of impacts from the pandemic is on work effort and where we may be a steadying, once the dust settles.
Yeah, I want to pick up on what you talked about there, which is the office vacancy. And obviously there's an office vacancy because of remote work, but there's an office vacancy as a result of people just not coming back in large enough numbers. Is that kind of a sleeping giant here that will hit our city economies in particular?
Yeah, it is. We're already seeing some of the manifestation of that across urban economies, and not just in BC, right across the country. You can, when one's downtown, they certainly can see. Maybe, it does vary a little bit, but for the most part, vacancy rates are lagging. And now, of course, the cyclical pressure, the structural pressure of the shift in the workplace model, it just, that we're getting clear of. Now, of course, the perfect storm shifts to some of the cyclical pressures. The fact interest rates are high and they're going to get higher. Unemployment is going to rise. Employment growth is going to slow. A lot of the employment, of course, fills the building. So this is going to be quite a drawn-out cycle within the office space. Certainly, if it's a new building, it's better protected, the amenities and the like. It's sort of the older buildings where it's a challenge. Now, I would say that in Canada, unlike the United States, the U.S. does have pension involvement in office real estate. In Canada, we do have a bigger element there, and it provides a little bit of an offset, just given pension funds are decently positioned to take on some of the risk of the office market. But in any event, it's a concern. It's not going to be enough to kind of send economy-wide into a significant recession, but certainly a worry spot that could really limit the extent of recovery as we move into 2024 and to 25.
Great. Last thing, because I'm cognizant of your time, what's the message been out here in British Columbia that you've been delivering about our own idiosyncrasies as an economy and our own strengths and weaknesses here in the next year or so?
Yeah, it's an economy that's had a terrific run. I remind myself of the strength. I remember doing a report on BC, and the economy had done quite well, but it was all driven by employment growth, very weak labor productivity. I look at the last 10-year performance, as our report was done before that, and BC has had a tremendous run of growth, 3% on average for 10 years through to 2021. Productivity growth that exceeded the nation. We're in a spot now where cyclically things are maybe cooling a bit faster into 2023. Housing has slowed more than average. That's both new building and the resale market. And then just household indebtedness, just more sensitivity there to the higher rates has slowed some of the retail spending and the like. So our view is it's not going to be, a very difficult ride, but certainly a bit of an underperformance, probably through this year and the next year. And then, the population growth is one reason alone to suggest that the economy will gain back on track. I do wonder, for example, Alberta, which has been taking in a lot of interprovincial migrants, we may see some of those in addition to kind of the new international migrants coming to the region, drive sustain strong population growth. It's going to create a demand impulse over the medium to longer term. At the same time, how is the region going to meet the needs of housing, infrastructure? It's going to be a real challenge. That's not new. I'm not saying that's new to the region, but certainly it's going to put even more pressure on governments to figure it out, because we're marking up our household formation rates significantly in our medium to longer term view because of the population steady state that we seem to be in. And that's going to be one of the challenges, I think.
Yeah. These are all great conversation pieces. I'm really happy we had a chance to talk today, Derek. Thanks a lot for your time.
My pleasure, Kirk. Thank you.
I'm Kirk LaPointe, publisher and executive editor at BIV. Thanks a lot for watching.